Hey, Accounting Essentials, Mr. Roberts here. Today we're going to go through Chapter 3, Lesson 1, and we are introducing a general journal. So this might be some new stuff. It's a lot of vocabulary to start because we're also going over source documents today. So just sit back for a second, try to absorb all the new vocab and the new way that we're going to record our transactions. So the objectives today is define what a journal is and explain why it's used to record transactions. Objective number 2 is going to be compare and contrast different types of source documents. And then number 3 is going to be identify the 4 parts of a journal entry. So let's get started. Once again, you can see that there's a lot of highlighted sections here because the entire beginning of this section is all vocab, and this stuff should be a little bit new. So we're going to take our time and go through it. It says in Chapter 2, we analyzed transactions into debit and credit parts using the accounting equation and T accounts. So remember, initially we did assets equals liabilities plus equity, and we just wrote it right underneath those, right? And then we got a little bit more specific, and then we created T accounts. So we were affecting, let's say, cash and supplies, and we wrote in debit and credit parts how exactly that was going to be affected. Now, we could go ahead and just write T accounts all over the place, but as we have more transactions and more accounts, that's going to be really hard to do. So what we're going to introduce is a journal, and this is a form for recording transactions in chronological order. And this is how most companies are going to record their transactions. And when we record a transaction in a journal, that's going to be called journalizing. So in the future, as we continue on, we are going to be using a journal and journalizing almost on a daily basis. So we're going to skip past the ethics part here. You guys can read through that. But the next thing is going to be our general journal. And this is what it looks like right here. Let me just make it a little bit bigger if this will pop up. And this general journal, you're only getting a snippet of it right here, okay? Just a really small part. But a general journal is going to be a large page, okay? So there's going to be a lot more than just 4 lines on this. It's like an actual piece of paper or in a computer, and it's going to fill up the entire page. So I want you guys to be able to get the scale of a general journal. It's like a lot. It's usually pretty large. It's not just 4 little transactions here. I don't really like how that picture represents that. So Delgado Web Service is going to use a general journal for writing down any of their transactions. And when we look at the different parts here, we have the date that we can record. We have specific account titles like cash, supplies, owner's equity. We have document numbers, and that's where source documents are going to come in. Post reference, which is going to be a tool that we can use to look at different kinds of transactions, which we'll get into later. And then we have a debit and credit part. So right here, we're going to be able to determine what kind of a way a transaction is going to affect an account by recording it under debit or credit. So this is really nice because of the accuracy of this journal, or the ability that it gives us to be accurate. We do have debit and credit parts here, and when we write down a transaction, we can tell pretty quickly, does debit equal credits? So that's really, really nice. We're going to write this in chronological order. So all of our transactions are going to be by date. This helps because we can see all of our transactions over multiple days in chronological order, and we can kind of tell that story of what our business is doing through these transactions. Remember, accounting, the language of business, when we look at a journal, okay, we're going to be able to tell a story of what's happening in our business. And then we have this very, very important term here, which is called double entry accounting. So anytime that we record anything in a journal, like information for a specific transaction, it's called an entry. So we journalize in the journal, and how we journalize is by entering in an entry. All right, a lot of new terms, but really what it comes down to is an entry is when we record another transaction, when we journalize another transaction. And when we look at accounts and we always affect a debit side and a credit side, that's going to be called double entry accounting. And think of it, I bought cash for supplies. Well, we have two different accounts there that are going to be affected. I think I said cash for supplies, or supplies for cash. So we have cash and we have supplies. I bought supplies on accounts. Well, now we have accounts payable and we have supplies. All the time, we have at least two accounts that are going to be affected. That's double entry accounting, okay, with debits and credits. Now, in Intro to Accounting and Advanced Accounting, we use double entry accounting. When it comes to accounting essentials in our Fox Valley Tech class, we don't use double entry accounting. That's probably the biggest difference between these classes. So next, let's take a look at source documents. And this might seem complex, and there's going to be 5 different source documents that we look at, but really, let's say you went to the store and you bought a new pair of jeans, okay? What are they going to give you? Well, they're going to give you a receipt. That right there is your source document to the jeans that you bought, right? And if you're looking at your bank account later and you go, ah, man, where did this $30 go? Well, you have a source document, that receipt, to track back and see, hey, what did I actually buy? In a nutshell, that's what source documents are. And a business, because we have so many transactions, source documents are just vital because we want to be able to track where our money is going. So here it says a business paper from which information is obtained for a journal entry is called a source document. Okay, different types of source documents are used for different kinds of transactions. So for example, here it says Delgado Web Services prepares a check stub for each cash payment that is made. The check stub describes information about the cash payment for which the check is prepared. We have this accounting concept here. This is a GAAP principle, and the accounting concept is objective evidence. So what that's pretty much saying is that objective evidence is applied when a source document is prepared. That means that we need an actual source document to know that something is true and accurate. So objective evidence is referring to source documents for our transactions. Because if you're a business, you can't just like go into a journal and go, yeah, I bought this day, I bought this day. We need actual source documents that show that we purchased those. So it goes down a little bit further. It says a transaction should be journalized only if it occurs. It must be accurate and true. That's based on this objective evidence. Delgado Web Services is going to use 5 different source documents. We have checks, sales, invoices, receipts, memorandums, and calculator tapes. We're going to go over all of those right now. The first one we have is checks. So, you probably don't write a whole lot of checks anymore, if you write them at all. Kind of one of those things that are going by the wayside. But think if you're a business, you're going to have to write checks because you can't really use cash. And you don't always just want to swipe your debit card. We need a source document that's going to tell us where our money went. And a check is just that, okay? It's going to pretty much tell a bank, hey, you can take out money from this account. That's what a check does, right? And the source document for cash payment is a check. So when we pay something in cash, our source document will be a check. And it says here, Delgado Web Services makes all those cash payments by check. We go over this a little bit more in Chapter 5, but you can see we have our check. This is going to be a document that we give to that individual. But then on the left-hand side, this is for our notes. So it shows, my check number 1 here, I gave out, and it was to Eastside Supplies, and I paid them, I paid them the $165 for that check. This is really important because if we just took out cash and we paid them with physical cash, where's our record? This is what we want to make sure we have when we're running our business. So the first one is checks, and it's going to be used anytime that we pay with cash. The next is going to be a sales invoice. So whenever services are sold on account, well, we need to create something that shows that we sold something and somebody will pay us back later. So this is going to be our sales invoice. This form is going to describe the goods or services that are sold, the quantity, the price, and then the terms, meaning when are you going to pay us back? Are you going to pay us back in 30 days, 60 days? What does that look like? So this is a very, very important document. An invoice used as a source document for recording a sale on account is going to be called our sales invoice. And this is going to also be referred to as a sales ticket or sales slip. When we create a sales invoice, it's usually going to have some kind of paper behind it, and we're gonna record it in duplicate, meaning that the person that received the services gets it, and we also get a copy, so we can see that maybe Main Street Variety here still owes us $500, and in 30 days they need to pay us, and the exact date that we rendered those services. Okay, if you just did it by word or by email and you said, hey, we're going to charge you, make sure you pay us back $500 whenever you have time, it'd be almost impossible to actually track. Okay, so let's keep going. This little section here is kind of nice. It says source documents are going to be critical when we find an error, right? And that makes sense, because if we find an error, where are we going to go to look? We can go directly to those source documents. Other source documents that we have, the first one is going to be a receipt. So this is a business form giving written acknowledgement for cash received. So when we receive cash and it's not a sale, this is going to be called a receipt. And here I just said like investment, right? So you can see, when do we receive cash that's not a sale? Well, how about when we receive an investment from our owner? So this is $2,000, and you can see that this is a receipt. It's showing that we received that money. Next is going to be a memorandum or a memo. And this is really nice because we can write a message on a memo. And that's really the main point behind it. Like, we can write something here. It's something that we can put a specific message in. So for example, if we bought supplies on account from Canyon Office Supplies for $220, we would create a memo. So when we look at this, you might go, well, why wouldn't we just write a check? Because here we're buying supplies on account. So we can't write a check for something that we haven't purchased yet. So this is kind of nice because it's the miscellaneous one. All right. Like if you don't really know what to use, you can use a memorandum and you can write a note on it. Next, we have calculator tapes. And for those of you that are cashiers, kind of think of it this way. At the end of your shift, I'm sure they print off an entire cash receipt, and then you got to close out your cash register, right, to see all the sales that you did for the day. Well, let's say you just have one cash register for your store. At the end of the day, we look at the entire calculator tape and we can see the sales for the entire day. This is really important because we're not going to record if we have a register in store, we're not going to record every single sale separately in our journal. We're going to have sales for a specific date. And this calculator tape is a source document that's going to look at daily sales. So you can see here, maybe we had 4 different sales in the day, totals $1,100. And this is for January 10th. Just kind of consolidates everything down. So when we look at journal entries, it's important to know that, if we draw a T account out, that's not an official document, okay? And that's important to know. We could be drawing it on the back of a napkin. When we journalize something, it is permanent. It is a record of the company. And usually we're going to use a pen for this. Now, you're doing it electronically, so you're not going to need to worry about a pen, but it's just important to know that you use pen and that this is a permanent record. So it's kind of serious. You're writing it down and you're saying this is correct. So now we've gone over source documents and we've looked at the parts of the general journal. Let's go over a couple transactions that we've already done, but now how do we journalize those? So I would highly recommend that you come back to these steps here. The first couple times that you're entering in or journalizing in the journal. Let's look at the transaction because they put it way down here. So if we take a look, It says in a journal, oh, give me 1 second. It says, received cash from an owner as an investment for $2,000, receipt number 1. So now we have a bit of additional information that we really want to focus on. We have the date of January 2nd. Okay, we have received cash from owner as an investment with the dollar amount. We've done that before. But then we have our source document, receipt number 1. So what I would suggest doing is the normal T account. The same thing that we've done before, the same thing that you did in chapter 2. Received cash from an owner as an investment. What's happening here? Well, or what accounts are affected? Cash and Michael Delgado's capital. So when we look at this, does cash go up or down? Cash goes up. We debited it. It's on the left-hand side of the accounting equation. Michael Delgado's capital is also going to go up. It's an equity. It's on the right-hand side of the accounting equation. It'll go up on the right-hand side. So when we do that, we actually write out our T accounts. This is still a great thing to do. But once we do that, we can use this information to journalize in our journal. So the first thing that we're going to do is write the date. And here we wrote January 2020 in the date column. Because it's the first entry in this journal, you see it's number 1, we're going to put the actual month in there as well as the year. Do not write either the year or the month again on that page. So let's say there's spots for 25 additional general journal entries. You don't have to write the month unless the month changes, or the year unless the year changes, until you get to the next page. So here it says page 1. Well, if you have to flip over and go to another page, then you rewrite the full month along with the date. For number 2, we're going to write out the debited account. So we always write out the debited account first, just like we did before in chapter 2. So that's going to be cash. We know that cash increases, and to increase an asset, we must debit it. So we're going to write in cash, and then we write in the debit column the $2,000 that is going to increase. For number 3, what we do is it's a little bit indented, and our books or our online working papers will do this for you, but just know it's a little bit indented. And then we write the credit account. So we have Michael Delgado's capital, and we're going to write in the credit account, because we must credit that capital to increase it, the $2,000. The last thing that we do is we're going to write down the source document. And like for receipt, it's just going to be R1. Okay, so source document R1 is the last step that we do. So 4 steps here. When we look at this transaction, do we go, is the accounting equation in balance? Yes, it is. We have debits of 2,000 and credits of 2,000. Okay, so the journal is going to consist of these 4 parts: date, debit, credit, and then the source document. And really what we're doing is the same thing that we've done before. Now we are just journalizing it in the general journal. So that's one transaction. Let's go through another. We paid cash for supplies. So we write out the date again, and you can see here that we just put 2, because above that we already have January and we have the year. Next, we write out our debit amount. Let's look at the transaction. We paid cash for supplies. That's one asset being exchanged for another asset. So supplies gets debited, cash gets credited. Okay, and we write out our T accounts here. Let's go up. We write our debit account first, which is supplies, and we write in the dollar amount of 165 in the debit account. Then we indent a little bit, and we're going to put the cash along with our credit amount of cash of 165. When I look at this, I go, ooh, supplies went up. Ooh, cash went down. That's the language right there that we can look at this. And because we understand debits and credits, we can see what's actually happening to these accounts. After that, we put in our source document. So our source document is a check. That's going to be written as C1. The 1 comes from check number 1. This will change over time, right? We'll have check number 2. Then it'll be C2. All right. So that is the end of lesson for 3.1. I know we covered a lot. You might have to watch this more than once. That's perfectly fine. All right, watch it at your own pace. If you have any questions, let me know, and we're going to move into the actual work together and on your own. So let's jump into the on your own and work together as well as the application problem. The first one's going to be our terms review 3-1. I'm not going to go over that with you every time, okay? It's our vocab. We've kind of already covered it. Please make sure that you complete it though. This is a little bit different view. You won't see audit your understanding here. So let's jump into working papers. And our first section of working papers here on the work together is kind of small, to be honest. There's not a whole lot of journaling to be done today because we're just starting out with a couple transactions. The thing is you already know a lot of these transactions. You're just journalizing them now. So let's look here. It says Norma Dirks owns Dirks Copy Center. Using the information provided, journalize each transaction completed during April of the current year. Use page 1 of the journal. Source documents are abbreviated as follows. Check is C and receipt is R. So let's just go through this real quick. We have our transactions here, April 1st and April 2nd. And then we have the chart of accounts, which is going to tell us all the different accounts that Norma Dirks has. So you can see all our assets, all our revenues, all of our expenses, liabilities, and equity. It's really nice. It helps us find if we see an expense and we go, oh yeah, this was for gas. I don't know what that would be. Well, you can go here and go, oh, it's utilities expense. Okay, so it's kind of nice. So we have that, and then we also have our transactions a little bit above this. And our first transaction is April 1st. See if I bring this down a little bit, it'll bring that up. Okay. On our date, what we're going to want to put in is APR, exactly as it's shown in this transaction, and then period. Okay, just got to get used to it. We do not put in the date, we do not put in the year. We're putting in the date, obviously, but we don't put in the year when it comes to our online working papers. If you're in a company, you would probably put the year in there. It all just kind of depends. So we're going to put April 1st because it's the first transaction on this general journal page. And now, remember, we did step 1. Step number 2 is right in the debited account. So it says we received cash from an owner as an investment. We can go back and look at that transaction if we'd want, but what I would do is I'd make a T account and I'd say, what's happening to cash? Well, cash is going to increase. So what do I have to do to cash to have it increase? It's an asset. I increase it on the debit side. So I know that cash is going to be the account that gets debited. So I'm going to write that in. And then in the debit column, I'm going to type in 2,800. Now, once again, I do not put 0.00. Don't put anything. All I want you to do is hit tab, right? And it's going to automatically put in the comma and the 0.00. Next, let's put in the credited account title. This is step number 3. So it looks like we received cash from an owner as an investment. So that's going to probably be our capital account. If I don't know exactly what to call that, let's go into our chart of accounts, go into equity, and you can see here it says Norma Dirks Capital. So that's what it's going to be called, Norma Dirks. You see, I spelt it wrong. It turned red, right? Norma Dirks Capital. And here, I'm going to write it in the credit column now because I know that Norma Dirks Capital increases. I make my little T account with capital, and I go, okay, how do I increase capital? I credit it. So 2,800 in the credit column. Don't have to type in anything else. Now when we go to document number, step number 4, we're going to write in the source document. And here it's receipt number 1. So on the debited transaction, right, this, you don't put it in the second one down, you just put it in once, and it's R1. So let's move on to the second transaction because we've successfully completed the April 1st transaction. For the next one, all we have to do is put in the date. We don't have to put in the month. So all I'm going to do is put in 2 here. I paid cash for supplies. I write my T account out and I say, okay, I paid cash for supplies. Cash goes down. That must be credited. Okay. What's the other account that's affected? It's supplies. That's an asset. How do I increase an asset? I must debit it. So I'm going to put in supplies. and it's going to go up by 415. And when we look at this, I paid cash for supplies, so cash will be the other account. This is going to be credited. Last thing I do is I put in the source document in document number here. So C1, because this is a check and it's check number 1. There we go. Now we have successfully completed the entire both of these transactions. We've journalized both transactions. You can see the debit side should equal the credit side as well. It's really easy to see in this journal. So let's save and continue. And what I'll do is I'll submit this without grading. So then you guys can kind of do the on your own. Okay, let's hit save and continue. And there we go, a 3 out of 3 on the work together. So make sure that you start working on the on your own. It's the exact same thing. And then after that, my computer will speed up, go faster. You're going to do the application problem as well. So if you have any questions on these, please let me know. And we will be continuing to journalize as we progress through this class. Thank you.